everyone. Welcome to another episode of Navigating the Markets with me, Markets in Mayhem. Consumer spending remains healthy amid a slowing GDP, which is a good sign for the economy, but a bad sign for inflation. It helps to keep it a bit stickier, particularly on the services side. And it's something that we should be keeping an eye on because some of the spending isn't really consumers consuming in the areas that makes money for retailers. They're not buying as much discretionary goods. They're slowing down on their purchases of autos. And we did see some encouraging home sales and durable numbers, but I have a feeling that those are going to be, wait for it, a bit transitory. So the US GDP reading we got was a bit disappointing as well. Part of that was that the inventory build we saw in the fourth quarter did not continue into this quarter. This is something I've been talking about as a bit of a theme, that build was not going to be run off at the rate that perhaps retailers thought. We often do see in the fourth quarter that build of inventory ahead of holidays. It's a bit of a seasonal theme, but we also see that consumers aren't buying as much around those periods. So that's a hangover effect that bleeds into the first quarter of the year, and this year was no different than that. We can see the labor market is healthy, but it is showing some signs of softening. Job openings are dropping and initial jobless claims are rising a bit, but there are still about 1.6 jobs available for every one person seeking work. And that means that we still have a rather tight labor market. And that's just really with those that are participating. When we look at the labor force participation rate, it's still quite low. In fact, every crisis that we've had, whether it was a dot-com bust, the great financial crisis, COVID, etc., has led to a lower participation rate. Yeah, granted, there are other factors driving this. There's more people retiring. There's the gig economy, and there's more people that are self-employed. They are not counted in the labor force. But I still think it's important to take this data into consideration because this is what the Fed is looking at. They do want to see the job market slow materially. They want to, unfortunately, see unemployment rise because they know that rising wages and a tight job market is supportive of upward inflationary pressure. And inflation's not dropping commensurate with the Fed's policy goals. They're still looking for 2% PCE before they become more sanguine about what's going on. And we do see also, they're kind of getting into this environment of stagflation, right? We've got a very slow economy that continues to slow further, and yet we have sticky pricing to the upside, particularly in services. Goods have come down. There's been disinflation and even some degree of deflation in goods, but services are another story. And what we saw on the goods side in March, that encouraging CPI reading we got last week, it's probably going to look different in April because we had, during April, a large rally in energy prices and some of the other softs and metals, and that's likely to boost PPI and to some degree CPI, particularly on the energy side. So I would be cautious before getting too optimistic about where this is going in terms of the inflation picture. Meanwhile, the 3s10s yield curve says recession's imminent. Typically, within about 4 to 6 months, this plays out from this type of a warning. And it's really important to pay careful attention when we start seeing that steepening, right? The steepening out of that deep inversion is what tells us that the recession could be right on our doorstep. It doesn't guarantee a recession, but it has a really high hit rate. And I would be looking at this from the perspective of one of many warnings. The other is that we've had 12 months of leading economic indicators in the negative. Since 1960, 6 months of negative leading economic indicators has always later led to a recession. We also have tightening credit. Banks are issuing less loans. This is a Fed policy goal. I don't know that they wanted banks to fail, but I think they knew that they would. And we have, of course, First Republic over the weekend failing. And I think it's important to see why. Yeah, the bank had some issues, but these are not issues that are uncommon. The bank itself has issues that are prevalent with many small, mid-sized, and large regional banks, which is really a common issue in banking altogether. This mismatch between the duration of their loan book and their assets versus their liabilities. So a bank has loan books. They consider that among their assets. They have assets they buy, like mortgage-backed securities, treasuries that create yield. They also have their liabilities, which are their deposits. Think about that. If the assets have terms of 2 to 10 years, and their liabilities are things that people can pull out practically at any time, by design, there's a mismatch. Banks are borrowing from the short end, whether it's from clients or otherwise, to engage in lending and purchasing on the longer end. So what happened at First Republic or Silicon Valley Bank or some of these others, it could happen at almost any bank if there is a flight of deposits at a high enough velocity. And there were a lot of folks out there that were trumpeting, oh God, we're all going to die. The financial system is going to collapse imminently. You had people like David Sachs and Genevieve Rochdechter going out there spreading fear that helped to catalyze some of these implosions. You also had Peter Thiel telling everyone to take everything out of Silicon Valley Bank, and tens of billions of dollars were withdrawn in a matter of hours. No bank can survive that kind of flight. None. They either fail and get taken into receivership, or they have a really bad buyout term, what I call a buy under. Buy unders tend to be problematic because basically a big bank is getting a smaller bank at a huge discount, and that's great for the big bank, but it's not generally good for these smaller banks or what their customers are dealing with, the loan relationships they have. It's just not an advantageous situation. So I would be concerned that we're going to see more of this as the year goes on, particularly in the back half. Unfortunately, I think we're going to have a culling of these small, mid-sized, and even larger regional banks because you're going to see a different type of crisis. This, what we saw, people just pulling out all their money, that's a liquidity crisis. We're likely to get into a solvency crisis. Unfortunately, a lot of these loan books are going to be upside down for these banks as we see more significant stress for small and medium-sized businesses, for commercial real estate, particularly in the areas of office space, and for home. Loans on mortgages, credit cards. We also have things like the revolving debt that people take out to do additions on their home, these equity lines. A lot of that stuff is going to come under increasing stress as we get closer to what I think will be a rather nasty recession. So I would not get complacent. I know Cramer also said, the banking crisis is behind us. We have to sort of fade that anyway, right? Because we know he's pretty much been wrong. He was pumping First Republic when the stock was, triple or double digits as well. Just all the signs point to some more trouble ahead. I hate to make light of Cramer, but he's been such a great contrarian indicator. Manufacturing ISM is approaching a recessionary level of less than 45. This is deep into contraction. It tends to lead the labor market and the economy. This is one of those leading economic indicators that I was talking about that's really important to continue watching. As we see manufacturing slow, and I would pay careful attention to new orders, backlogs, shipments, prices paid, prices received. That's the data that's going to help us get a better hold, as well as the employment data that comes out of ISM. And guess what we have coming up this week? ISM. So that will be helpful to get a better idea of what this leading economic indicator is telling us for the month that just happened. I think we'll see some signs of deterioration, but I don't think it's going to be quite as bad as what we saw during March. Instead, what I think is there'll be just more contraction, maybe a reading of 47, maybe a reading of 48, but anything below 50 is contraction. Anything below 50 is still bad, right? 50 is basically break even. So if we are having these issues of contraction at a slower rate, it doesn't necessarily mean we're out of the woods. But I do think eventually these readings start to come down and we do get into that recession territory. But we'll pay attention to the data that is coming, and I'll cover that shortly. The other thing we saw is a flight to safety. A theme that I've talked about is this great rotation out of stocks into treasuries and investment grade debt. And we can kind of see that. Look at the year-to-date flows. This is a pretty big difference from what we've seen in prior years when there was financial repression. People were much more bullish of equities and, they were hanging back a little bit more on their bond purchases. Look at 2021, for example, a very bullish year for equities. That was where all the money went versus bonds. This year, it's completely different so far. And if we annualize those flows, we can really get a sense of what that might look like. So this is part of it. If you're older and you're looking for a stable income rather than riding the roller coaster of the stock market at historically high valuations for where we are in the credit cycle, you're going to go into fixed income. You're going to get treasury bonds, notes, bills. You'll probably build an income ladder, a bond ladder. From that, you'll probably also get exposure to AAA investment grade debt, maybe some emerging market debt. There's a lot of opportunities in fixed income that haven't existed for the really over a decade. And if you're older, if you're in your late 40s or especially your 50s, 60s, and 70s, these are opportunities that are generational. These are opportunities that are hard to pass up. And investment advisors are probably telling their clients, look, the stock market's trading at like a forward PE of 19. And at the same time, you've got, 4+% yield that you can get on debt that is guaranteed by the full faith and credit of the US government. Maybe you want to look at that. I'm sure that's what they're being told. And I believe that's a part of the theme that I've been calling the Great Rotation. So last week, we had an interesting environment. We had oil down 1.6%. Bonds were up 0.8%. A bit of that recession trade theme starting to come back a little bit. The NASDAQ was up 1.3%. Year to date, up 16.8%. The S&P and Dow up 0.9%, with the S&P up 8.6% year to date. I think what we're starting to see here, though, is that people are a little too excited about these tech stocks. Yeah, the earnings weren't as bad as hoped, but they weren't great. I mean, Amazon's earnings per share are down something like 94% from the first quarter of 2022 to the first quarter of this year. That's not great, especially when you fired 12,000 people. You're firing another 8,000. You would think there'd be some cost savings there, but of course they've spent about $450 million on severance for the 12,000 they fired. Now of the 8,000, the composition of higher paid workers is actually higher. So they're probably going to have an even higher outlay for severance in the second quarter. I'd be a little concerned about what's going on there. Google also doesn't look so good to me. I'm not a big fan of the new CEO, Sundar. I know he's not that new at this point. He's been there for 2 years. He's getting paid $200 million to basically overgrow the company and then have to haphazardly shrink it. Many employees were fired over text message. Others are being told to come back to the office, work hybrid, share desks with others, even getting restricted access to new equipment and even things as simple as staplers. That doesn't tell me the company is really running well when management's overpaying themselves and yet employees are kind of getting the short end. That's not going to help with morale or productivity. They're in an AI arms race with a lot of other well-equipped competitors like Microsoft, and that could be a defining moment for search as we move forward. So I would be watching all this very carefully. I think what's going on in tech is we've had one of the best runs into earnings season since 2009. And I get that people are very optimistic, but that's pulled forward some of the returns we could have expected post-earnings. So the after earnings returns we've seen in the 82% of the S&P that has reported so far, that reaction's been about 0.1% in these stocks post-earnings. All things considered, that is telling us that some of these returns have been pulled forward. And the heat map from last week shows us that Microsoft was a clear winner, along with Meta, Comcast, Charter. Starbucks did pretty well, but this is a lot of a mix. You can kind of see it in the patchwork of bright green, dark red, bright red, and just sort of neutral colors. There was not very good breadth. And this is a theme that we've seen throughout the market for most of 2023. In fact, only 7 mega cap stocks have accounted for 90% of year-to-date gains. This is some of the most narrow breadth we've seen since late 2021, and narrow breadth tends to lead to larger drawdowns. It doesn't happen right away, but when it happens, it's hard to miss. And this is a trend that goes back decades. And we can see that consensus sees just a 4% peak to trough decline in EPS. I think that's just a smidge optimistic. We can see during other challenging environments like the dot-com bust, great financial crisis, even COVID, earnings declined by double digits. I would be very surprised if we don't see a similar outcome this time around, particularly given the extent of Fed hiking, the tightening of credit conditions, the stress that consumers and businesses are facing. And once the sort of sugar high from all this government spending and the last 14 years of liquidity sort of surging throughout the financial system begins to wear off, I think we are in for a more challenging period. So I do believe the consensus is looking at this with rose-colored lenses and not really realizing that we're actually in a pretty big spot of trouble here. Earnings next week are going to be super busy. I think there's a lot to digest, but I believe that everyone will have their eyes on Apple after hours on Thursday. That's going to be easily the most important earnings. I am cautious of this one. Why? Because I think we're seeing some signs that Apple might be in trouble. Their computer sales are down 40% year over year. Their largest manufacturing partner, Foxconn, has said that their growth from their sales that are sourced from Apple has slowed materially. We saw that the iPhone 14 didn't get a great reception. It was more of an incremental improvement rather than, the game changers that we've seen in some of these other iPhone releases. And I would be a little bit concerned about the services side, because what's the easiest thing to cut when you're a consumer and you're struggling to pay your bills? It's some of these subscriptions that they have in entertainment. And I think, that could compress Apple's top line and bottom line a bit. So I would look at Apple cautiously, both with their earnings and their guidance. They may beat excessively conservative estimates, but I would be more concerned about what do they look like quarter over quarter, year over year, with their earnings, with their revenue, what are their margins looking like, and really, what is their guidance moving ahead? You also have some other interesting stocks reporting that I think are worth watching. I'm certainly not going to be able to cover all of them, but Diamondback Energy, it's a really well-run natural gas and oil producer, very, very high performer in 2021 and even did pretty well last year overall. Obviously, they're struggling now with natural gas prices as low as they are, but one to watch. MicroStrategy, I like to watch for my amusement. They're also on Monday after hours like Diamondback, which, Michael Saylor has tied the entire future of this company on Bitcoin. It'll probably look pretty good because Bitcoin has rallied, but I don't think that this company is out of the woods yet. It's also one of the most highly shorted crypto stocks, so be careful shorting it because it behaves erratically and irrationally, due in part because of that. We've got Pfizer and Uber on Tuesday before market. We've also got Cheniere, really the biggest liquefied natural gas exporter, on Tuesday morning. They're probably not going to have the best earnings or guidance given the price action we've seen in natty gas and Europe demanding less because they have a surplus. We've got AMD after close on Tuesday. That's going to be a really interesting one to watch. I am a fan of AMD, but I do think that the whole semiconductor industry is challenged right now. They're dealing with a glut. Last quarter, we found out AMD was artificially restricting supply while at the same time trying to boost prices. I don't like that look. It tells me they're struggling a bit. So I'd be surprised if this quarter's earnings are that great. We saw, again, PC slowdown. Apple's not the only one. The average slowdown in the PC space about down 29% year over year. So AMD's products are going to be in less demand in that side. And then on the data center side, I think they'll do okay, but I still think there'll be slowing of their products for servers, for the cloud, and otherwise. So I'd be keeping an eye there. And then looking throughout the week, there's a lot of other earnings to keep an eye on. It depends on what part of the market that you're really interested in. There's something for everyone here. There's tech, there's energy, there's pharmaceuticals, there's some of these growth stocks, there's other crypto like Coinbase. So my advice, if you're looking at this from the perspective of trying to learn, read the transcripts or listen to the calls and take notes. Look through what management are doing, what they're saying. Try to learn what you can, not only about the company, but their industry, their sector, and the broader economy. There's always something to learn from earnings. And we have a very busy week in economic data. We've got, as I was mentioning, we've got ISM, manufacturing PMI, Monday at 10 a.m. So tomorrow morning, keep an eye on that. The manufacturer employment reading comes out as well. The consensus is 46.7. Maybe we get a slight bump over that, but that doesn't mean we're out of the woods. Remember, anything under 50 is contraction. So if you see people out there saying, oh, look, we got a better than expected reading, it's 47, 48, it still means they're slowing. It's just less than what we saw during the prior reading, if we get that. JOLTS jobs openings is another one that's very important on Tuesday. The Fed watches this one closely. The last reading was 9.9 million. The consensus for this is about 9.68 million. I'm looking at this one very closely as well because this is what defines part of the ratio of how many jobs are available for unemployed insured person out of work. And what that means is if you're on unemployment insurance, you're counted among the unemployed, right? It's a weird thing. After a while, you're not counted anymore, even though you're still unemployed. But it's important to look at that versus the JOLTS jobs openings, okay? The next one we have is ISM Services PMI. That's to be Wednesday at 10 a.m. I'll be looking at that very closely, as well as the Fed interest rate decision that we have at 2 p.m. and their press conference at 2:30 p.m. We need to watch these events closely. The Fed's likely going to raise by 25 bips. I don't think they'll change their quantitative tightening at all. They may leave the window open for another hike as early as June. I don't think there'll be much more than that from the Fed, but they're likely to pause and hold. Once they're done, I don't think they're going to be like prior hiking cycles where they immediately pivot and start cutting unless something very big breaks. I believe that instead, they're going to hold for some time, probably through part of 2024 before the first cuts. And I think the next cutting cycle will look different. The Fed has even said they're considering the idea of continuing to do quantitative tightening as they cut, which would bring us to a completely different paradigm than what we've seen in the last 14 years. The balance of trade on Thursday will be important, as will non-farm payrolls and the unemployment rate on Friday. So keep an eye on all of these as we move throughout the week ahead. We also have a fair amount of Treasury auctions in the bills. Not going to be a big market mover. These are usually well-subscribed. Money market funds gobble this stuff right up. And I don't think that this coming week will be any different. So looking at this more just from an informational standpoint, you've got a lot of that happening really on Monday and Tuesday. I don't think these will be market movers, but I still think it's interesting to watch for demand. So that's everything I've got for you all. I hope that this has been a helpful edition of Navigating the Markets. If you have any questions or feedback, feel free to leave them in the comments section or post them in the questions room on the Discord and tag me in. And I will look forward to talking to you all in the week ahead.